Now it's time for hot picks. At one time, electric utilities were seen as a sleepy investment category, slow growth in the dividend, for example. But now, of course, they're red hot with the soaring demand for power to run AI data centers. Our guest has Eversource Energy as a top pick. It's a provider of electricity and gas service, and he reckons it's trading at a discount. Our guest on Hot Picks, Daniel Rich, Senior Equity Research Analyst at CFRA. Daniel, thanks very much indeed for joining us. Tell us about Eversource. What's distinctive about them, please?
Yes, and good morning. Thank you for having me here. So it's a timely question because, as you may see here, Eversource Energy actually picked up a bit of bad news this morning that I can explain. So Eversource is an electric utility based primarily in the New England region, so Massachusetts, New Hampshire, and Connecticut. And they've had some regulatory troubles in recent years in terms of local regulation that has put the stock at a discounted valuation relative to peers. Now, we are very bullish on the name because of the discount. We think that the growth potential in terms of earnings per share growth and capital expenditure opportunities in the region, as well as dividend growth, are pretty competitive with the peer group and meriting a better valuation. Now, this morning, the stock is trading down a significant amount because the Connecticut Utility Board basically denied Eversource's ability to liquidate or divest its water utility in the state. It's a minor business, 2% of the revenues in 2024. And why we think the stock is down is primarily because of what it says about the regulatory environment in Connecticut. Not necessarily that the water business is so significant, but if regulation is tightening, that is going to put pressure on shares. Now, again, going into this morning, we held a strong buy opinion, and we saw, like I said, the growth potential in terms of their rate-based growth, their ability to grow their asset base. We're expecting around 8% annually over the long term, which is quite competitive with the peer group. And the dividend yield is 4.3%. Up until now, it's probably even higher with this news. So we will need to rethink our decision here based on this news. But again, I think it's primarily potentially an overreaction, really, based on regulatory concern and not so much a financial difficulty, whether or not they can divest the water utility.
And sorry, you may have touched on this, where is their core customer base, Eversource?
New England, so primarily Massachusetts, but also somewhat in New Hampshire and Connecticut. And like I said, Connecticut's sort of the thorn in their side right now in terms of local utility pushback, regulation pushback. So again, we saw shares trading over 20% discount to the peer median before this morning. Now we're probably looking at 25 to 30%. And this is a stock that historically has traded around 16 or 17 times forward earnings. And now we're looking at a stock that's probably south of 13 or even 12 times earnings. So again, unless the company comes out with some significant guidance change after today's decision, which I don't expect, we do think that there is considerable upside potential here for long-term investors in Eversource.
Your next idea, a huge player, Duke Energy. What attracts you there?
Right. So Duke Energy, this is one of the largest electric utilities in the United States, long-term, sort of traditionally run name, and they are primarily based in the Southeast, so North and South Carolina, Florida, as well as the Midwest. They have operations in, for example, Ohio and Indiana. So Duke Energy is one of the names that we think is leading the way in terms of the infrastructure build out for data centers and artificial intelligence that's going to be needed in this country. Their capital expenditure plan was recently increased from $87 billion to what we think is going to be $95 billion from 2026 to 2030, which is significant in terms of the electric transmission and distribution, natural gas distribution, and new electric generation capacity in terms of gas, but also renewables to power all of this electricity demand that we're seeing. So they're projecting what we think is a pretty attractive pace of electricity sales growth in their service territory. Next year, somewhere between 1.5% and 2%, and then an acceleration of electric sales, 3% to 4% growth from 2027 through 2029, which is well beyond historical norms. And we think also customer growth in their territories, particularly in the Carolinas as well as Florida, is very healthy. It's also supporting their ability to, at the regulatory level, get all of this capital spending approved. And we do think it supports a potential earnings acceleration towards the end of this decade. For right now, Duke tends to grow their earnings about 6 to 7% annually in terms of earnings per share. What we're expecting is towards the end of the decade, think maybe 2028, 29, an acceleration maybe to the 7 or even 8%, which would put it at what we think is a higher echelon, a more competitive valuation relative to peers. The shares do yield 3.6% of dividend currently. And like I said, the data center trend, especially in North Carolina, is attractive. Amazon Web Services had a $10 billion investment that they announced recently going to support Duke Energy.
We'd better keep it moving. I'm sorry, you've only a minute left for your last idea. Sorry about that. Sempra Energy, what attracts you to this stock?
Right. So Sempra, this is a company that is primarily based in California and Texas, two very attractive markets, especially the Texas market, which is probably one of the fastest growing in terms of electricity demand and data center growth. This is a name that we think, after a lot of divestitures of non-regulated businesses in Mexico, for example, and a lot of their liquefied natural gas terminals in Central America, they're expected to see their earnings sort of bottom this year and then accelerate in the future. They're having an attractive 7 to 9% growth target in terms of earnings per share. We think they can reach the top end of that potentially. And like I said, because of their divestitures of non-regulated businesses, the earnings mix of their regulated operations is probably going to be close to 100% as opposed to about 80% today. So we think it's a less risky play, and the valuation should benefit as a result.
Daniel, thank you very much indeed. Daniel Rich, Senior Equity Analyst at CFRA.